There's a step-by-step system on how to get an investment property as a new investor. Now, most beginners, they think they'll need perfect credit, tons of savings, and years of experience. But in reality, first-time investors are skipping deals every day simply because they don't understand the process. If you don't learn how to buy your first rental the right way, you'll either overpay, buy the wrong property, or worse, never get started at all. So I'm gonna walk you through the exact step-by-step blueprint that you can use to start investing in real estate. So I just had the benefit of working with a first-time investor. I call him a rookie because it's so funny. Sometimes you buy your primary home and you're living there, you're like, you know what? I wanna buy an investment property. But so many clients get overwhelmed. They don't know where to turn for education. A lot of these social media gurus give bad advice, believe it or not. They may not be licensed to do these type of mortgages. They just give advice on social media. So I had the benefit of working with a recent client, and it was so cool walking through the process. So typically number one, it's like, take a deep breath. We're gonna deploy the keep it simple strategy for you to invest in real estate. So we went through the whole process, right? We talked through how much they were to put down, what their credit profile looked like, what structuring a deal for a rental versus moving in as a primary. You don't really care about rental naturally, what that looked like, and walking them through the process, guiding them on how to pull the team together, right? The right real estate agent, a great insurance agent, and a couple different things we'll talk about in a little bit. They were able to go from an anxious first-time investor to finding a great deal, putting 20% down, the property cash flowed every single month, $1,000 more than the mortgage, which is a great deal. And they're super happy investors. So this year, 2026, they're looking to buy even more investment properties because they love the process and they see the big picture from an investment perspective. So what I'm gonna do for you guys right now is I'm gonna go over the 6 typical steps that all of my first-time investor clients always go through, deploying the keep it simple strategy, of course, but kind of walking you through the process just like I did with them. So by the end, it totally makes sense. And maybe even you be ready to buy your first investment property. All right, guys, I actually wrote the 6 key steps here. I actually left off the 6 because you're gonna have to wait and watch to the end because the 6 is the most important and it's the best. But I'm actually gonna write it out myself at the end. I pre-wrote some of these just to be transparent because my handwriting is horrific, and if you think this is bad, if I breeze through, it'll be even worse. But these are the 6, right? I haven't written out the 6 yet, so make sure you wait to the end, watch at the end, because that's the best one. And we're gonna base these around the DSCR mortgage, the debt service coverage ratio mortgage, the go of all investment mortgages, which is the specific investment tool for you to buy all your investment properties. Now, the first step is getting your financials in order, and there's a lot that goes into that, right? There's your credit score, there's your credit profile. It's gonna be like this: credit score, credit profile. There's gonna be, let's say, your assets. So some people say, hey, Andrew, my credit score is a 720. How come I don't qualify? I was told I don't qualify. There's more that goes into it than just the credit score. Now, the good news is the DSCR mortgage is an investment mortgage that starts with, hey, are you buying an investment property? What's your actual credit score? Now, credit reports have typically 3 credit scores. The lenders work with the middle of the 3. So if it's a 600, a 700, an 800, your credit score net effect is a 700, right? If it's a 600, a 600, and an 850, I've still never seen an 850, you have a 600, believe it or not. So just understand, of the 3, they're gonna work with the middle typically. But it doesn't just stop at your credit score. The credit profile is more often than not more important than the actual score. So the profile is when we look at your actual credit report, the actual debts, how you're paying them, are you paying them on time? I've seen clients with a 720 score have mortgage lates or have bankruptcies. So just understand the profile. Are you paying your debts on time? Have you had any type of huge issues, right? Judgments, delinquencies, bankruptcies, foreclosures, modifications, late mortgage payments, that type of thing. They're gonna look at with a lot of scrutiny because on the investment side, they're just qualifying you, which we'll get in a little bit. On the market rent, they're not looking at your income documentation, none of your pay stubs, they don't even ask if you have a job. So they're gonna wanna make sure that your credit profile is exceptional. And the third piece, getting your financials in order, is the asset side. So good news, as the DSCR loan, month over month, the guidelines are loosening up. They actually don't even check large deposits. As long as you have the money in the bank by the time you're about to close, you qualify. But you will need the money in the bank by the time you close. So the asset side, typically, we've seen at least a 20% down payment. Sometimes you're first-time investor or a couple different circumstances, maybe more. So you just have to understand, and when you do your pre-approval, which we'll talk about later, but just understand before you even reach out to a loan officer, it's the worst when you have conversations like, hey, so nice to have a conversation with you, Bill. Looks like you want to be a first-time investor. So what's your credit score? 740. Great. How's your profile? Amazing. Never missed a debt payment. Awesome. What does your asset profile look like? Well, I have like $5 grand. I've seen all these social media videos. I think eventually I'll save another 1 or 2,000, but I'm looking to buy a $500,000 house. Just understand what you're getting into. You're going to need enough assets in your account by the time you close, and you can't really wing that stuff, right? And it's also, we don't ideally want to pre-approve you or tell you that eventually it'll be okay for you if you're not going to have enough money. It's like we're not doing our job fiduciarily speaking. So just make sure, guys, besides your score and the profile, make sure that you are prepared to have enough assets to actually buy an investment property. Now, the second is investment strategy. Before we get into it, I think the best thing for you guys right now is go in the description, click the link, and download our investment mortgage worksheet, right? We have an awesome worksheet that goes over all the stuff that I'm going over. Now, I geek out over this stuff. I've worked with thousands of clients on these type of mortgages, let alone 10,000 clients just in general for mortgage. I've been doing this for quite some time, but you may not be or may not have done an investment mortgage. Maybe you're a first-time investor like the video says. So just make sure you go in the description, click the link, download our free guide, and follow along as I get into the rest of it. All right, so the second, which is the investment strategy. There's a couple things to understand. You have to understand before you get into an investment purchase. Are you going to base it on long-term rental, short-term rental, or is it really just like truly going to be a flip? So a flip, we'll kind of cancel that one out. A flip is when you buy a property, maybe put some money into it, and then you resell it. So, whether you're going to carry it or rent it for a short period of time, you just have to understand the carry costs of buying a house, renovating it, maybe renting it for a short period of time, and then eventually flipping it. So I'm going to count that one out. It's the third, but if that's your strategy, this video may not be for you. We have other videos about flipping houses and, some of the benefits there. But some people, they kind of like buy it, rent it for a little bit, then flip it. So if that's your strategy, you just have to make sure you're going in, fully educated on what your carrying costs are by the time you actually sell the property, the actual monies you make, which you're paying back some of the things you've laid out, that there's still profit for you. And there's oftentimes some investors make mistakes there, especially first-time investors. Now back to the first, long-term. What does that strategy mean? Long-term means you're going to buy the house, close, and you're going to put a renter in place. And they're going to do either a yearly, a 2-year rental, 3 or whatever it is. So they're going to pay every single month, and they're going to pay that mortgage. That's just a long-term rental strategy. And why we bring it up, there's something called a short-term rental strategy. Think of an amazing house in the Hamptons or in Montauk or in Miami on the water, right? Or maybe in California in some of the different areas. Sometimes, seasonally, during the winter, if you did a long-term strategy over 12 months, you wouldn't get that much for it because people just don't want to rent it outside of maybe June, July, August, right? Memorial Day, almost to Labor Day. But people flock to these places, say from Manhattan or maybe out of this area, other countries, and they're willing to pay a ton of money each day or each week or each month. I've seen properties that if they would have rented it for the full year, they don't make close to covering the mortgage, but just by renting it specifically for the June, July, August days, weeks, or months, they crushed it. They killed it. And just by renting it those 3 months, it covered the yearly all-in mortgage payments and had a surplus. So maybe that's your strategy, but it's good to know going in. Are you going to buy yourself a short-term rental property or long-term? It's always good to know, especially early in the process. Now, the third is analyzing the deal. Now, I do a ton of videos on DSCR loans, so go watch them if you want me to really dive into the third at length. I've done a ton of videos, so check out my page. But just shortly to analyze the deal, just think, like we said, a $500,000 sale price is an investment property. Maybe it's a 2-unit property. So you're like, hey, Andrew, I want to buy a 2-family or a 2-unit home for $500,000. I could put down the $100,000, no problem, Andrew. It's a $400,000 mortgage. And if we just roughly base this off of a rate of 7% with a 7.5% APR, maybe that's $2,800. Maybe that's an extra $1,000 for taxes and insurance. So say the all-in mortgage payment is $3,800 a month. So when you analyze the deal, everything you're going to do is kind of based off of this $3,800 a month number, which I can do with you, or you could do with your mortgage professional initially. But just remember, these qualify off of market rent. So a 2-unit property, you have unit 1, you have unit 2. Now, if they're $2,000 each, that's $4,000. The rent covers the mortgage. You consider that a good deal. What if it's $2,500 a month each, market rent, right? That's $5,000, leaves a surplus of $1,200. It's an even better deal, which my previous client, remember they had a $1,000 surplus? What they had. Maybe you just love the property and you want to get into the investment side, but it's only $1,000 a month in rental, fair market rent. That's $2,000, which is less than $3,800. That's potentially no bueno. You're buying a property to be an investment, but doesn't cover itself, so maybe it doesn't make sense. Or to the point of the short-term side, $3,800 a month. That's about $45,000 for the year. Now, what if it rents for $2,000 a month, $1,000, but you could rent it for those 3 months short term for $15,000 a month for 3 months. It's $45,000, like I said, it would cover. That's a case of where short-term rental would make sense. So when you're analyzing the deal on an investment purchase, especially on the DSCR side, first is like, hey, what's the mortgage payment? Next is, hey, what's the market rent? Typically the realtor, which we'll talk about in a little bit, the realtor is going to help you with a market rent estimate, or the appraiser, when you're in contract, will give the market rent estimate. But that's really the thing that you have to know, because it's all on the deal, which is the rent going to cover the mortgage? Now, the fourth is the pre-approval and the team. So the pre-approval process, make sure you use someone that specializes in these type of loans. And what does the pre-approval process look like? Ask you a bunch of questions. You're going to fill out an application. Typically, they do a credit check, and they're going to go over your asset portfolio, your asset position, and what you're going to need to close. So there could be a way that some people just have a phone conversation, ask for, hey, what's your credit score? How's your credit profile? How much money do you have in the bank? Cool, let me issue a pre-approval. Unfortunately, that is not doing their job from a mortgage professional perspective. They have to actually do a credit check. They have to get some of this documentation in, see that you own another property, not just take your word for it. That's what a real pre-approval does. But with pre-approval, that's you as the client being pre-approved, and then really doing diligence on the property you want to make an offer on, almost pre-approving that property from a deal perspective, because you can qualify potentially for anything if you put 20% down on your first-time investor, as long as the rent covers. But what happens if that property, the rent isn't covering it? You really want to kind of pre-approve that property from a rent perspective before you make an offer. So the pre-approval side is very important, and it's going to save you a lot of time, effort, energy, and real heartache if anything were to go wrong, just doing a really deep diligence pre-approval up front. Now, the second piece is the team. So you have the lender, you have the realtor, you have an inspector typically, you have insurance agent, maybe a contractor. I told you my handwriting is solid. So there's a lot of people. You're going to amass a really cool team. So you got to make sure that every single one on this checklist is great. Because just like in anything, right? Think of football. If the quarterback's great, and the running back's great, and the receiver's great, but your offensive line stinks, and I'm saying this because I'm a Jet fan, clearly, you're smoked. You're not going to win, right? It's the same thing in mortgage. And when you're trying to buy an investment property, the lender could be great. The inspector could be great. Your insurance provider, eventually, when you find a house, could be awesome. Your contractor, maybe you want to do some work, is great. But if your realtor isn't, they're not going to get you a good deal. They're not going to get you an accepted offer, and you're never going to get a house. So just make sure when you think of your team, when you're about to purchase an investment property, you get the whole team assembled and the right people. And these are the type of people, again, the right lender. If you use the wrong lender, obviously you're not going to be able to close. Realtor, either getting you not a good deal, which you really ideally want, or just not getting you an accepted offer in general, because right now, throughout the country, it's very much a seller's market, typically. The inspector, if you have an overzealous inspector, every time you go into contract, they might overdo the inspection and say that the house is a disaster. Maybe it's not. There are some inspectors that are very, very conservative. Also, on the opposite side of the fence, there might be very liberal inspectors, and they don't tell you all the things that are wrong with it, and you buy a property with a lot of stuff wrong. So the inspector is very important. Insurance provider, if you have the wrong insurance provider, maybe you got a quote for $8,000 a year for insurance, and now all of a sudden the numbers and the deal doesn't work, but they just don't have good carriers, and maybe the real insurance is $2,000 a year. So the insurance company work is very important. And lastly, the contractor is very important, because maybe you're like, you know what, if I buy this property and I put in $20,000 of work, it'll cash flow and it'll be amazing. But if that contract is a ripoff and says it's $100,000, you might walk away from a deal where you could have made a lot of money, or at least cash flowed from a rent perspective on an investment. So the contractor you choose is very important, both their service levels, but of course their cost. Now the fifth step, of course, is making offers. I always call this, back in the day when I was young, shop till you drop, right? So you want to go out there with a great agent, great realtor, see as many properties as you can and make as many offers as you can. But just understand, when you make an offer and it's accepted, the fun doesn't just stop there. Literally, the game hasn't even started. But so you have to go out there. The next step is start seeing properties, making offers, and eventually when one is accepted, that's when number 6 happens, which is my favorite, when the fun begins. So number 6 we'll write out is go into contract, close, rent, right? So first thing is, when you make an offer and it's accepted, depending on the state that you're buying in, you might go into contract very quick, right? Florida's very quick as an example, but New York is very slow. You might make an offer in New York, it's accepted, then you get it inspected, then the seller's attorney, it's an attorney state, has to send the buyer's attorney a contract. Then you wait. This one's on vacation. Maybe it was snail mail. It could be from accepted offer to being in contract to buy. In New York, could be up to a month, could be a week, could be 3 weeks. So you want to speed from offer accepted to contract typically in New York, because until you're in contract, it's not really yours to buy. But again, it's really state specific. Some states, when you make an offer, it's accepted. You could be in contract same day, next day. Now, that's when the mortgage professional takes the baton, and we pretty much do everything from contract to what I would call close. What does that mean? We get you the initial review approval from the lender underwriting team. We order the appraisal to make sure what you're buying it for. Call $500,000. It's actually worth $500,000, and if it's not, will you make up the difference, or do you want to, get out of the contract? And the third piece is the title report, making sure there's no issues on title, the seller actually owns the properties, no judgments getting in the way of you having clean title and owning the property. So those are the three things we do kind of concurrently, and typically within 2, 3, 4-ish weeks, you're ready from contract, you're actually ready to close. So closing is great, yay, go to the closing table, bring the monies to close, get the keys, life is good. But it doesn't just stop there on these, right? You're not just like moving in, it's an investment. So the most important piece is get your rent, get your renter, the person that's gonna rent out your property, get them lined up. Because understand, right now is April of 2026. And if you close in April of 2026, the good news is in mortgage, your first payment's June. So that gives you a little bit of a runway to your first payment. But guess what? June comes fast, very fast. So if you don't have a tenant in place that's gonna pay you rent very quick by the time June comes, you're gonna start fronting these payments yourself. So it doesn't just end in contract, doesn't just end at closing when you get the keys. It ends to me when you have a renter in place and they start making rent payments. So now that we went over the 6-step process, the DSCR loan, why it's so cool, make sure you watch the next video. Why 99% of investors don't use DSCR loans. People are making mistakes left and right, guys. So just make sure, don't put yourself in the same position. Watch the video of why 99% of investors are not using the DSCR loan, just to educate yourself.